Good afternoon, ladies and gentlemen. Absolutely delighted to welcome you back this afternoon to our session on managing in distress. My name is Sue Staunton and I'm Joint Managing Partner of James Cooper Creston, and I'm really pleased to have alongside me this afternoon two of my partners from our insolvency and restructuring team, Sandra Mundy and Paul Davies. Yeah. And we know that over the last few months that many businesses have been struggling, and our team has been very busy helping those sorts of businesses. So can I hand over to Paul? And Paul, we hear of a number of businesses who through the last year, despite government support and so on, have been struggling to renew or increase their facilities with their banks because their financial results perhaps have been poor over the last few years. Do they have any other options?
Yeah, thanks, Sue, and good afternoon, everyone. I suppose the short answer to that, Sue, is yes, they do. I know Stuart spoke on the previous section about finding funding and where it's available, but from my point of view, I deal with clients that are having those issues. High street banks are, I think, a bit reluctant at the moment to be looking at anything that's not a vanilla client. So anybody who's been having some financial issues, but there is a vast array of lenders away from the high street, and these lenders cover all areas of risk appetite, really. So they might range from one of the big banks like an ABN AMRO type bank, where they're just slightly behind the high street, still looking for the better businesses, profitable businesses, right down to the bottom end, where you might find the bridging providers, small end financiers, even distressed investors looking to put money into businesses. Now, I suppose from a client point of view, the issue is cost. So what we find is the more risky the lend is in the view of the lender, then obviously the greater the cost. And also what we find is lenders are really looking for tangible security a lot of the time. It's very difficult to find lenders that don't require that sort of tangible security. But there are some lenders out there that will look at it. But again, it does depend on that sort of risk profile, really.
And you find you talked about the distressed sort of lender end of the market. Is that something that's become much more prevalent recently?
Yeah, I think so. And we've seen particularly invoice discounting over the years has become more and more popular to the point where it probably finances SMEs as much, if not more, than high street banks now. So it's really interesting and there are a range of other facilities out there. So we've got trade finance, there's development finance, there's bridging finance. As I said before, there's cash flow loans, albeit I don't think there's too many lenders in the market for that at the moment. But again, once we see the end of the pandemic, I think we'll see these markets open up. There is money out there for people to lend. What they're looking for really is returns on that, and hence the cost becomes important.
And you talked about looking for security as well. I mean, I guess that's more challenging these days, isn't it? 20 years ago, many businesses would have very physical assets, but the nature of the sort of businesses in the UK at the moment are that many just won't have that. So what do they do?
Yeah, indeed, it's very difficult. A lot of businesses traditionally would have owned their own premises as well, so they'd have the freehold there. But in this day and age, a lot of leasehold now. So tangible security really comes down to, a lot of the time, if there's no property there, you're coming down to inventory, and inventory funding has become more difficult because of the recent stance in the government changing its status on preferential claims, which has reduced the amount of inventory available. So you're right, it is difficult for that tangible security. And I think the issue for a lot of directors that they've got to come across is they're getting asked for personal guarantees, and those personal guarantees are being backed by property. And usually that's a marital home, and lenders will be looking for that, particularly where there's distress, because they obviously have a concern that the company might not be able to meet its obligations, and therefore that security, that property security, is actually coming from the directors personally a lot of the time.
Yeah, and that's a challenge as well, isn't it? Because I suppose the banks are sort of saying, well, unless you're prepared to put your money where your mouth is, then we're not. But equally, it makes the director, more vulnerable.
Yeah, that's absolutely right. Yeah, if the director doesn't back themselves, then why would a lender back them?
Yeah, exactly.
Indeed.
Now, we know that where businesses are having difficulties, some of them are being told now by their banks that they want to send in accountants to complete a review of the company. So what's all that about, and what should those sorts of companies in that position actually do about that?
Yeah, I mean, the banks refer to them as independent business reviews, and what the bank's trying to do is trying to ascertain the current status of the business. So they've obviously got an issue with the company. There might be a breach of covenants, something along those lines, or the business might be requiring further funding. The bank sending accountants to do a review of the business and the finances, and effectively present an options report to the lender to say, this is what's going on, and this is what we think you need to do moving forward. Mm-hmm. Now, we complete them ourselves for a number of lenders, and in fact, it's almost an options analysis. We also complete them sometimes for shareholders or directors that they might have a complex group structure, or they might just have lost control a little bit of the business, and we'll go in and sort of advise them what the way forward is. Now, the issue, if the bank has brought somebody in, they'll bring somebody that they'll appoint somebody to go in and do it. And I think in those circumstances, we'd be recommending that you take advice yourselves, because the bank and that accountant might be pushing you down what's the best option for the bank, but in reality, that might not be the best option for you as a business. So we would recommend, if that happens, that you would take your own advice as well, just to make sure you're not being pushed down the line that the bank wants, because there may be other options available. So yeah, we'd always recommend that.
Thank you. And Paul, you're currently UK president of the Turnaround Management Association, so you're very heavily involved in the restructuring side of the market and the sector. What are your views on what's out there at the moment and what's happening in the marketplace?
Yeah, it's a really interesting market for us at the moment. The moment you mention any firms of, say you're an insolvency practitioner, everybody just goes, oh, you must be really busy. and interestingly, we are really busy as a team, but actually the sector itself isn't that busy. Insolvency numbers are still significantly below pre-COVID levels. The reason for that is government support predominantly, either by way of furlough or C-bills or bounce back loans. The revenue are being very supportive in terms of time to pay arrangements. What we're finding at the moment is they're happy to agree a time to pay arrangement, but they want one in place, so they won't just let that deferred money drift. Winding up petitions are blocked, evictions are blocked. We've got low interest rates, so people can still afford to pay their debt back. So the culmination of that is we just have low insolvency stats. Now, from the turnaround point of view and seeing from my work on the TMA, I think we're seeing a lot of people coming to us now saying, what do I do? What happens when? And it's always good advice to take advice as early as possible, because the number of options you've got available are definitely more. The earlier the better is the answer. We have seen a direct impact on the obvious sectors, travel and tourism. We've dealt with a number ourselves, hospitality and leisure. Those sectors are definitely being hit hardest at the moment, but hospitality and leisure is a good example where they've probably got no staff at the moment because they're probably all furloughed. They've probably done some sort of rent deferral or write-off with their landlords. Their revenue debt has been pushed back and they'll be on some sort of time to pay. And actually, there's probably very little cost to keeping it alive at the moment. The challenge for them is going to be when the banks start wanting to get paid again, when the revenue start being paid, they've got a C-bills loan and this debt pile they've built up over the last 12 months. Suddenly they've got that overhead that they didn't have 12 months ago. So whilst it has supported businesses through this period, the problem's going to come once they have to start repaying all this debt that's being deferred at the moment. I mean, interestingly, from, I suppose, a personal opinion, I can't see insolvency really peaking. I mean, it could still be another 12 months, 18 months away before we start to see a peak of insolvency as people try to get to grips with that debt. I mean, C-bills loans, for example, the first repayment of anyone is probably around April time. So there's been 12 months of no payments. Suddenly these payments are going to have to be made. And they can be quite chunky numbers in some circumstances with the C-bills. Bounce back loans, the government are trying to intervene and push back the time. You can have it over 10 years. It's a set interest rate. CBILS are not like that. They've not been controlled like that, and I think we'll see quite a big impact. I think the last stats I saw was default rates were anticipated around 40%, which is a very, very big number in terms of CBILS in particular. I think we'll see quite a big impact.
And do you have a sense that, you know, for whatever reason in terms of the greater good and so on, but that we have got a number of businesses that are really sort of the zombie type businesses where there's really the walking wounded and probably should have stopped by now?
Yeah, I mean, I think without the government support, we would have seen more insolvency because people wouldn't have been able to carry on. So that's definitely the case. The term zombie companies has been around probably since 2009. And I think it's the biggest element of that is debt is so low. And the problem for the economy is that if businesses just tick over and don't really do anything, it doesn't really help the economy. The economy really needs that sort of cycle of ups and downs. Where, I mean, we find insolvency is not the middle of the recession when the insolvency is busiest. It tends to be on the uptick as it comes out, where you start to see the difference. And what you want is people speculating and putting money into businesses. And we need that funds flow. I think the advantage we've got at the moment is there's so much money in the private equity market and the funding market. Particularly, we see a lot coming out of the States in the secured lending market. So there is money out there and people want to put it into businesses. It's just trying to manage that risk appetite. But I deal with a number of distressed investors that specialize in helping and investing in businesses that are in trouble. They obviously, that's what if you saw the last session with Stuart talking about numbers in terms of equity percentages, distressed investors going to want a lot more for a lot less money because they're going into a business that's in trouble. But there are some specialists in there that are trying to make money out of distressed businesses and also help and turn around businesses that are struggling, where debt isn't an option. And going back to the secured lending point, if there isn't any security, equity might be the option to try and find somebody that will come in alongside you to put that funding in. Yeah.
Okay. Thank you. Thanks very much for those thoughts, Paul. That's really helpful. Sandra, turning to you, and you know, picking up on a point that Paul made about directors often having to stand as guarantors for lending where we've not got any assets perhaps in the company. So that, you know, they're putting themselves and their personal assets at risk as well as the company. In addition to that, I think, you know, a number of directors of failed businesses also have sizable claims brought against them by insolvency practitioners if the company, you know, goes into insolvency. What types of things should directors be aware of so that they can, you know, protect themselves really?
That's a good question, Sue, especially in the current environment where people are going to be sort of reopening businesses that have been shut for a while and really a little bit uncertain about what the future might hold for their business. I think your director that is alert to these problems should be looking at the financial position of the company on a regular basis and asking themselves whether the company is insolvent or not. And it's not that it's illegal to continue to trade a business that is insolvent. It's just that the risk for the directors become much higher because if that business then fails, the corporate veil, the benefits of limited liability of a company can be pierced by the insolvency practitioner, and they could well be looking to the directors to repay monies that that had been taken from the business. And I think so in terms of knowing the financial position of the company, I think directors should be aware that there are two definitions of insolvency, and if either of the tests of insolvency are met, then the company is insolvent at that point, and therefore from that point onwards they are at risk from, if the company was to subsequently fail, at risk from potential claims from insolvency practitioners. So the definitions of insolvency are Firstly, the cash flow definition, which is probably the more pertinent of the two tests that we apply, which is whether a company can pay its creditors as they fall due. And the second being the balance sheet test. So is the level of the company's assets exceeded by the level of its liabilities? So if either of those tests are met, then the company can be defined as insolvent. And from that point on, the directors run additional risks, potentially, if the company then goes on and fails. So at that point in time, they should be moving away from their primary focus being creating wealth for shareholders to that of protecting the position for creditors. And if they do that, they are then minimising the risk for them personally if the business were to subsequently fail. So the sort of things that an insolvency practitioner would be doing would be looking at the directors that have held office in the 3 years prior to the insolvency event, and looking at the transactions that had gone on in the period from the onset of insolvency. So when either of those conditions for the insolvency test were met. And what they'll be looking at is, has there been any wrongful trading? Now, that's been suspended during most of the parts of the pandemic, but that is due to be reopened again shortly, just at the point in time when businesses are starting to try to reopen and get back on their feet. So I've not heard any further announcements from the government recently to say that suspension will continue. Mm-hmm. Then they'll be looking at things like, have there been any transactions at an undervalue, any preference payments, misfeasance, illegal distribution. So directors that might be quite used to taking their earnings from a business by way of a dividend from their shareholding as opposed to salary. Some of those transactions will be looked at to see, well, when that dividend was paid, was there available capital to be able to, available resources to be able to distribute at that point in time. Mm. They'll also be looking at things like missing pension contributions and things like that.
And by which you mean pension contributions for staff? Yes,
yeah. So I mean, you know, that's quite a political hot potato at the moment, because I think most businesses will be aware that everyone is now required to or all employees are required to have the option of being in a pension scheme. And whereas in the past, I think that was less prevalent. I think most employees probably are now in a pension scheme, and if the employee's pension scheme that's been deducted from their salary has not been paid over to the pension company, that is a big issue for directors potentially, with potentially criminal liability attaching to it.
Yeah, so fairly significant then, and I think your point about dividends and certainly a number of owner managed businesses, you know, the directors will be remunerating themselves by a mix of dividends and salary, and we certainly see that occasionally, where people aren't always keeping alert to whether they've got the reserves to pay those dividends, and that's then presumably, as you've just said, at risk should the company ultimately go into some form of insolvency.
Yeah, it certainly, you know, claims will potentially be brought for illegal distributions, and the shareholders would, if that claim is proven, the shareholders and directors, quite often the same people, may well have to repay that.
Whereas, of course, if they've drawn a salary,
yeah, that's not attackable. Yeah.
So very, very interesting. So, what would be your tips then? I mean, you talked about, you know, being alert to whether a company is either coming into insolvency and so on, and managing the business, but how would you recommend that the key things that a director should do if they're worried about the circumstances their business is in from a financial point of view?
Yeah, I mean, I think you're absolutely right. I think you should be keeping a very close eye on those finances and identifying when you're sort of approaching that twilight zone of you know, is it solvent, is it insolvent? And that may change day to day, week to week, depending on how the trading performance is continuing. So I certainly recommend, as a board of directors, looking at that on a fairly frequent basis until you have a little bit more confidence that the trading performance is going sustainably going in the right direction. And that's probably best done by way of board meetings, so that all the directors are aware of the situation and all have input into that decision to continue to trade the business. I'd certainly be saying that it would be appropriate to be making minutes of those meetings. And the reason I say that is if at some point in the future things don't go as planned and the business does fail, an insolvency practitioner like myself or Paul typically look at this with the benefit of hindsight. So we will ask questions, well, why did you make that decision then? Why did you decide to pay this person here? And actually, it can be very difficult for directors to cast their minds back what might be a number of years to be able to identify the reasons for the decisions taken at the time. So with the benefit of some good board minutes, explaining what was known at the time and what considerations they took and what factors influenced those decisions. That's very good contemporaneous note of why those actions were taken at that point in time, and actually is much more difficult for the insolvency practitioner to then be able to dispute. Of course, it may be that the decisions that they took were not the right decisions, but that doesn't mean to say that they weren't the right decisions based on the information and knowledge that they had at the time. The other things that I would be saying is, if you're getting quite anxious about the solvency position, a bit like Paul was talking about with the independent business review, you may well want to be taking advice. And that advice can give the directors a level of protection. So if you were to come to an insolvency practitioner and say, I am concerned about the solvency of my business, that doesn't necessarily mean that that insolvency practitioner is going to turn around and say to you, well, I think you should be putting the company into liquidation or administration. It might well be a period of saying, well, let's have a look at what your options are. Nothing wrong with you continuing trading, but just be aware of the risks. And actually, if you see this, this and this happening potentially, then I think we should have a further conversation about whether it's appropriate for you to continue to trade at that point in time. I suppose one other measure that directors may want to think about is whether they take directors and officers insurance policies out. That would protect them potentially from if a claim were to be brought against them by an insolvency practitioner. It may give a payout if, for example, a transaction at undervalue was demonstrated against that director. That policy potentially would pay out. It's unlikely that that policy would pay out if there was fraud, but if it was something of the nature of a transaction at undervalue or a preference, then that should pay out, and therefore the impact on the director personally would be much lower.
Thank you. And you talked about the importance of board minutes and sort of documenting transactions and so on. Would you recommend that where a director enters into a particular transaction with the company, so I don't know, say buys a car from the company or something like that, that should be documented at that sort of time as well, so that they can explain that, you know, the market value and that sort of thing, which was easier at the time?
Yeah, absolutely. That's a perfect example of somewhere where you would want a very detailed note as to why you did it. So those type of transactions which involve a director which aren't in the ordinary course of business, so buying a car from a company that was in financial distress, I absolutely understand why a director might do it, because it would provide a cash input into that business, and you know, he gets the benefit of, or he or she gets the benefit of having the car that the business once owned. But you're quite right, an insolvency practitioner would very much look at transactions that involve the directors that weren't in the ordinary course of business, and they'd say, what was the motivation, and did this have a negative impact on the creditors? So things like having a valuation for the asset that transferred out, and to demonstrate that that a full market price was paid rather than it was set against a loan account, for example, which is probably of no benefit to the remaining creditors of the company. Those sort of things really should be documented.
Thank you. And changing emphasis slightly, Sandra and Paul, if we're seeing more distressed businesses, I think we've all acknowledged that, even if we've got some that sort of being kept alive because of the governmental support and so on. Are there opportunities for business owners to actually acquire distressed businesses? And if there are, how should they go about it? Paul, do you want to pick that up initially, and then perhaps Sandra can chip in?
Yeah, I mean, yes, there is. I mean, there's definitely going to be opportunities out there. The main thing is I would always say take advice, and the reason for that is it's actually very difficult to understand the nuances of the Insolvency Act, and actually there's a lot of things to think about when you're buying a company out of administration. So I would definitely say get an insolvency practitioner involved on your side to help you through that process, because obviously we're used to doing it the other side all the time, so we can definitely add input when you are buying. And just help try and understand how the insolvency practitioner is going to look at it and what sort of amounts they're going to be looking for, how are they going to value the assets, etc. So yeah, but you're right. I mean, there's going to be a huge amount of opportunities for somebody who's cash rich and looking at certain sectors. Then yeah, definitely keep your eye out, because there will be some good opportunities out there.
Yeah, it might be that you're looking to buy a competitor, or you might actually want to buy a business as a defensive mechanism, such that another of your competitors doesn't actually acquire it and then acquire a huge market share at your expense. It might be that it adds a new geography, which might be great. It might add a new some new intellectual property, for example, that you haven't got in your own business. It could be a complementary business rather than a competitor that you're buying. You could even be concerned about somebody that's critical in your supply chain, and that you absolutely need that supply going forward. And your best way of protecting that is to actually buy that entity. So I've sold businesses out of an insolvency process for many numbers of reasons. But I suppose the question that the purchasing entity really does need to ask themselves, of what value is this going to be to me going forward? Yeah, so I've seen a huge range of reasons why someone might buy something.
And what are the pitfalls that you commonly see acquirers of insolvent businesses falling into?
I think the biggest challenge is trying to merge the business into your current business. It's mainly operational is the real challenge for businesses. They're probably working on different stock systems, different account systems. You've got a different set of employees that have all worked in very different ways previously. So yeah, I mean, I'd say definitely don't underestimate the difficulties that you'll get in trying to merge the two different businesses. Particularly, they're probably going to be in two different locations as well. And it is difficult to try and make sure that everybody's dealt with the same and you've managed to get everything up and running. And it takes time. Bear in mind, it will take time to get everybody onto the same systems and everybody working in the same way and everybody feeling like they're an integrated business.
The other thing I think you've got to be very mindful of is the reputational damage that the kind of business you're buying has suffered during that process. And what you've got to be very key about, or very aware of, is the message that goes out into the marketplace, and the story that you're telling customers, etc., such that the new business going forward isn't tarnished with the reputation of the old business. That's quite a difficult one. And also, I mean, similar to what Paul was saying, I mean, the integration bit is quite difficult, but you will also get suppliers to the old business hounding you for payments that have absolutely nothing to do with your current business, and are suppliers of the old business. So I think there are a lot of integrational issues. But that said, if you can buy something at the right price and provide something additional to your business, I think there are some great opportunities out there, and I wouldn't necessarily look to discourage anyone doing it, but they do need to go into it with their eyes open.
Well, that's an important point, I think, Sandra, you know, the eyes open, because of course, you know, buying from an insolvency practitioner means that you won't get the opportunity and the luxury of doing extensive due diligence or the sort of going through the paperwork and getting contractual warranties and so on, because it's very much what you see is what you get. And
quite often the criticism of insolvency practitioners is that you sold this thing very, very cheaply. That's the criticism creditors may level at you. But when you actually think about this situation that you will find yourself in, you may only have a matter of weeks to be able to market and sell this business, 2 or 3 weeks. So it's certainly not like a normal sales process where there may be months of due diligence going on. You're absolutely right. They will get no warranties, no indemnities from an insolvency practitioner. And the reason being is the insolvency practitioner generally has no knowledge of what went on previously, so can't give those warranties and indemnities. And you are buying a business with a potentially difficult reputation in the marketplace. So I'm making this sound all very negative, but actually it does go to price. And I still go back to my earlier conversation, my earlier point in the conversation, is that, you know, some good deals are to be had, and I've certainly seen some businesses that have done very well having bought something out of an insolvency process. Would you agree with that, Paul?
Yeah, definitely. And especially at the moment, because of the pandemic, there's a lot of good businesses out there that have been impacted massively. And actually the underlying business was fine pre-pandemic, and it'll probably be fine post-pandemic, but it might just have some serious working capital issues. So I do think we will see some really good businesses that have proven pre-pandemic that they are good businesses. So yeah, I think there's going to be some great opportunities for people that have got the cash to be able to do it.
Great. Well, thank you both very much for your time. I think it's been very, very informative, very, very useful. I'm sure that our audience out there in the ether will agree. Any further questions from anybody out there, please do post them up on our site, and we will get answers to you directly after the close of the conference. Thank you both very much.
Thank you, Sue.
Thank you.